Okay, Chris, we've got a good number of people who've joined us live already. I will turn it over to you whenever you're ready to go.
Looks like we've got a packed house. Heather, they're coming in. Thank you very much for kicking off. And I will go on ahead and I'll just kind of run from here. Well, I know we're going to have other people join us as we go. I think we've got a couple hundred participants. Wow, already in the room. So for those of you that joined on time, thank you for being here. And we'll get started today. Welcome. This is not something that we have done very often. In fact, I was telling some of my team, it's been almost feels like a decade since we were doing webinars. We're so into or so committed to the one-on-one interaction and connecting across phone calls and I think our team does such a great job of outreach that, we didn't do as many of these webinars over the last, probably 5 to 10 years as we had when we first started. But as we were looking around, it kind of dawned on us that there should be a lot of questions right now from investors. If there's not, I mean, that speaks to a bigger problem, but there should be a lot of questions right now that investors have. And what better way to get out, really the best way to get out in front of as many people as possible and answer questions that investors should be asking right now than to host a webinar like this and to do it live. We don't do a lot of recorded stuff, although this will be played for others in the future. For now, we want to get on here live. We got a lot of questions from investors on the front end that registered. And I see a lot of names on here that I recognize from our clients. And then there's a lot of names I don't recognize. That makes me excited. I know there's a lot of people on here that are learning about our company or trying to figure out, what do I do? And what better way to find out what to do than to get with a company that has, look, we've been around for 2 decades now. Next year, we're celebrating 20 years in business. We started off as a very small company in a very challenging market, in a very, kind of an odd time to be buying real estate. And we've gone through these cycles up and down now multiple times. So I feel like we're in a really good position. I never say that we're an expert. I just say we're experienced. We've got a lot of experience in how to navigate challenging markets, and make no mistake about it, this is challenging, but also an incredible opportunity. And I'll get to exactly why, we look at it like that. Before I get started, I'm not going to spend a lot of time on this, but I want to make sure that everybody joining us today kind of just has a quick lay of the land and kind of understands where we are right now in the market process. So the state of your company, this is just some quick little facts here. And I want to make sure that that you guys understand. I picked this topic, or I picked the name of this slide very specifically. All right. It is the reason why I named it the state of your company is that, make no mistake about it, we are a partner with everybody that does business with us. While we operate the company, we make the big decisions, and we are certainly trying to move the company forward in a positive direction. This is our company together. So when I titled that slide, the state of your company, I wanted you to understand, if you're an investor with us, this is where we are right now. We currently have just under 7,500 properties under management. We have over 3,000 investors who we manage their portfolios for them. We have over 450 investors that are members of the WOW group, and that number grows every single month. Now, what does that mean? These are investors that own 5 or more houses. Today, their portfolios are valued at north of $1 million each. We are managing a total of $1.45 billion in assets for our investors, just like all those here on the call, just like everybody here that wants to be a part of this group. That's the value of the assets that we currently today are managing. The picture you're looking at right there is a picture of our corporate headquarters in Memphis, Tennessee. We have roughly, this changes kind of day to day because we're hiring and always still growing. I believe today it's around 130 full-time team members spread out in 11 different markets. You can see the markets there. A majority of our team work in Memphis and Dallas. Those are our hub markets. The other markets are the spoke markets. So in other words, the hub is where all the back end and the back room operations is concerned. The spoke markets have team members out there in the front. They are reviewing houses, overseeing renovations, overseeing the management and the leasing of those assets that our that our owners own. And a couple of real high level things for you guys. These are two things that we're super, super proud of. Our vacancies remain extremely historically low. It's hard sometimes to imagine how well our team performs and how they keep vacancies at the level that they are. But we have a 1 o'clock meeting every day of our leadership to oversee our numbers, oversee our stats, where are we at, kind of get out there in front of any trends that we see happening. So vacancies remain below 2%. Today, we have fewer than 130 properties vacant that we are trying to lease up on some level across all 11 markets. Many of our markets have fewer than 5 vacancies today. A big market like Memphis, where we're managing almost 4,000 houses, we have, I think the number was 51 vacancies today. So if one of those is your property, understand all of our attention and focus is going right to it. And if you are one of the investors that doesn't have a vacancy right now, congratulations. There's many more like you, and that's what we're trying to get everybody to. One day, and it may only happen for one day, but we feel like at some point we're going to get this down to no vacancies. Every property occupied. We'll see if we can get there. Same thing with maintenance numbers. We continue to see, again, we're better than industry average maintenance because we are driving maintenance down through high level renovations on the front end. I'll get more to that later. But I just wanted you to know that as we look at this high level review of the company real quick, this is how the performance is. Now, we're not going to spend a lot of time on these numbers because I know you guys really joined us for other stuff. This is the state of the company over the last 6 months, just as important, equally as important. All right, so we've only experienced 445 move-outs through the first 5 months of the year. This month, we expect to have a low number of move-outs. I do not anticipate that we will experience more than maybe 1,100 total move-outs for the year. We understand that August, sometimes that September, that little time frame, we see a slight uptick, but so far we haven't begun to see that yet. We might be able to hold move-outs below 1,000 for the year, and if we do, that is going to translate again into a average length of occupancy of over 7 years. This will be the 6th year in a row that we hit that type of number. So we work hard to prevent move-outs for our owners. One of the ways we do that is we renew leases. So far, through the first 5 months, we have renewed 1,247 leases. What does that really mean on the big picture? That means 1,247 leases were set to expire. We could have let those leases expire, allowed the property to go vacant, and then once it went vacant, we would be in a position to be able to, once it went vacant, we would be in position to be able to lease that property up and collect that first month's rent. Our average rent is around $1,500 right now. So this is roughly $2 million that we say, I don't want. I'm going to keep that. I'm not going to force that move out. I'm going to do everything I can to keep that resident in that property, prevent our owner from experiencing a vacancy, from experiencing a move out, from experiencing the lease up costs and everything else. So we did everything we can so far this year to prevent move outs. This number will be roughly 1,400 to 1,500 after 6 months. We expect to renew 3,000 leases this year to prevent move outs for our owners. Now, of those renewals, 98% of the renewals so far have seen an increase in rent. Our average so far for the year was 6.5%. Now that is a data point through the first quarter. The second quarter, our rent increases have been higher, but we wait until the end of the quarter to put that full reporting together. I anticipate that our average rent increase for the year after 6 months will be closer to 8%, maybe as high as 9%. Some markets doing better than others. Some markets that have been around longer are certainly doing better. But we try, and I want to make sure that I'm clear with everybody on the call. We try and keep rent increases to a very normal level. I don't want to force rent increases. We don't want to force vacancies through the rent increase. So if the most we can get on a rent increase is $25 a year, we'll do it. If we can get 50, we'll do it. But we don't want to force a move out. What we want to do is steadily get rents up to the proper amount where they need to be, and we have time to do that. rents generally lag other values. And so if we can keep a resident in a home and over a 2 to 4 year period, get a property up to the rent where, where it needs to be in that 4th year, but do it slowly over time, that's perfectly fine, as long as we don't force the move out. Now, here's why. Let me see if I've got this number in here. Yeah, here's why this matters so much. So I want you to pay attention to the net rental income paid to owners. We've paid out so far $39 million through the first 5 months. This number will be closer to $46 million through 6 months. We are on pace to pay well north of $80 million this year in net rental payments. That means after all of our fees, after any maintenance fees that come up, after anything at all right, anything whatsoever, we're gonna take those expenses out and we're gonna send back to our owners over $80 million this year. We're set to reach a number that we weren't even sure was possible back when we first started. We never imagined we'd be sending this amount of money, and we are within 2 years of sending $100 million a year in net rental payments to our owners. That is phenomenal. It's what's helped us so far for the year. We're on pace to have a record year. What I mean by that is we have 515 sales closed. This is a number that we are guesstimating because we kind of already know how the month of June is going to end. We anticipate the month of June will end somewhere between 512 and 515 closings for the year. So through 6 months, we're on pace to close north of 1,000 transactions for you guys, for our owners. And first-time investors, this is something that we are very proud of. First-time investors make up 30% of our closings so far year to date. That means that 7 out of 10 homes this year have been sold to an existing investor building out their portfolio. And that's really the big story. That's the part that I want everybody on here to really understand, like, why? Why is that the case? And why do we anticipate it remains the case going forward? So there's great interest, but we're not having to churn. As a company, we don't have to go out there and try desperately to find new investors to purchase the portfolio that we are buying that we believe makes full sense. Investors are able to see that, hey, I'm building out a portfolio. I'm dollar cost averaging. I'm building out for a big picture, not a small picture return. And so because of that, 70% of our existing sales continue to existing investors. Some who bought last year, 2 years ago, 5 years ago. This year, we've already had investors, and this is another cool thing to me. We've had investors who first started buying over a decade ago, building their portfolios this year. That's the ultimate understanding of, hey, this is a long-term play, not a short-term play. And that's really what we want to talk about today. All right, so moving on. I'm super excited everybody's here with us. I kind of threw out a little bit of kind of where we are. I want you to understand as I move forward, make sure I'm really, really clear that the state of the market is really important. Look, I have some money in the stock market. I even have some money in the crypto market. I don't understand it. I do not have a full, like, in-depth knowledge of it. What I know is the real estate market. This is where I would say 90 to 95% of all my investments are done inside the real estate market. So I'm not knocking any other ways that people want to invest, not at all. I've got a lot of friends that do very well and have done very well in other investment strategies. I talk to them. If I want to know about the stock market, I talk to some other people who are smarter than me. I go to them for advice. Of course, the same thing with real estate. If they want to invest in real estate, and they all do, they come to me for advice because they want to know who the smart guy in the room is. So I wanted to just point out before we move forward, if you had put money in the stock market roughly summer of last year, you're down 31% today. Dow Jones down 18%, S&P is down 23%, Bitcoin's down 57%. They're all getting killed. I still have my money in there because I know that I don't actually lose anything until I sell. So for now, I'm just chilling and waiting. Again, it's a small part of my portfolio. However, had you purchased a DFW property between last summer and this summer, you're up greater than 22%. I say greater than because my data is just from January 1st to today. This is just through the first quarter. Sorry, this is first quarter data. It doesn't even include so far the second quarter data. So Dallas real estate on average up 22%, Houston up 18%, Little Rock up 13%. San Antonio is up 22%. Birmingham up 14%. This is the value of the real estate in these markets. Oklahoma up 12.5%. Memphis up 17%. None of the markets year over year are down at all. None of them are up less than double-digit returns. That's pretty damn good. That's one of those things that when we look at it, we say, wow, that's a kind of data that we always knew would exist. It kind of reaffirms the idea that real estate is a great investment for those that understand and have good, clear like idea of this is what I'm doing and why I'm doing it, what I'm trying to get to. So let me pull this up right here. There we go. Okay, so the state of the market. Let's talk first about interest rates, because that's what's on everybody's mind. It's what's been on our mind. Let me tell you where I think interest rates are, what's happening, and where they're going. Interest rates are they're going to be a big driver for us in the next, I would say, 90 to 180 days, where they will play an outsized role. And the reason why is because of the state of our minds, kind of where we are, what we're reading about. They have been in flux, and I anticipate that they're going to remain that way. I think that this is one of those rare times in history when we can look at a data point, and everybody talks about looking into that crystal ball and what do you see? Well, we can look into our crystal ball and see that most likely, and I mean, there's a high likelihood that rates will go up in the near future. I believe rates will go up for the next, as I said, 3 to 6 months. We may see an end of the interest rate hikes for the mortgage interest rate increases by the end of this year. Okay. And then we level off into more of a new norm. This is the way it's going to be for a while. I want to point out that there's highly likelihood, and I'm not an economist, I'm not going to go here, but I will tell you there's a lot of thoughts out there. I think I read yesterday that 70% of the economists surveyed believe we will go into a recession. If you look back historically at recessions, generally we exit those recessions after 2 years. At the end of exiting the recession, interest rates, especially mortgage interest rates, are below where they were when we entered the recession. So wherever we end up towards the end of this year, within 2 years, I believe we will be below. So interest rates are a massive driver right now for a lot of our demand, a lot of our psyche. You know, who's moving forward? What are we doing? They absolutely drive or a big driver in yield, but the nice thing about interest rates is that they also provide opportunity in markets like this. So I believe that this is a nice time and a good time to begin looking at, should we use other than a 30-year mortgage type product on interest rates? I always caution people on this, because if you've ever heard me talk, you know that I'm not huge on leverage. I like using leverage to acquire, but I like to pay off as fast as possible. I don't use leverage to hold. In a scenario like this, I am a big fan of using adjustable rate mortgages. Let me give you some data here just so you understand what's happening right now in the markets. I like adjustable rate mortgages because right now I firmly believe before that mortgage matures, that 5 or 7 year or 10-year arm, in that time period, rates are going to come lower than they are today. And I can then lock in at a long-term rate. But I can get in now at a lower rate. I can lock in long-term at a rate that is going to work for me at some time in the future, better than what the 30-year rates are today. I want to give you some data. If you're taking notes, write this down. So number one, this is a very different market due to interest rates than what we had back in 2007, 2008. A lot of people are wondering, what's going to happen? Interest rates going up, it's going to kill and crash the market. Well, let me tell you where we are on interest rates. So the average FICO score of a lien holder in 2000 and today is 751. The average FICO score of a lien holder in 2010 was 699. This data comes from CNBC, from Diana Olick, who is somebody I read a lot. She's interviewed me in the past for some articles that she's done. She's just a fantastic researcher and writer. So less than 8% of the loans today are adjustable rate mortgages. In 2007, 36% were adjustable rate mortgages. In 2007, the underwriting was horrible. It was sketchy at best. Today, adjustable rate mortgages are written on average at 7 or greater than average, 7 to 10 years. 80% of all ARMs are 7 to 10 years today. And they're written to a fully indexed rate today, not the rate that you're getting in that adjustable rate, but what it could come to. So that's the way that they are writing and the standards they're applying before they are giving out those adjustable rate mortgages today. Could that change at some point in the future? Sure, but we're just starting at a really good point. We were starting at a bad point back 15 years ago. We're not there right now. Right now, we have a very healthy and strong market. And here's one of the reasons why. Home values, they continue to remain strong. They've shown amazing resiliency over the last 4 months, including to continue to go up in value. The reason behind that, there is $11 trillion today in available equity after leaving 20% in the home. So mortgage debt today stands at 43% of total value of the 53 million first liens that are available out there. 43%. So there is an incredible amount of equity out there that has not been tapped, has not been touched. Those properties are not coming to the market in some rush state right now. Many investors, many homeowners are just sitting. They're sitting on what they have. They don't need to move right now. The demand is coming from first-time home buyers, second-time home buyers, move up. It's what we call normal consumption, normal household formation, moving from apartments, moving from a first home into a second home, moving from a rental home into a first home. This is basic household formation. And we as a country are multiple millions of homes behind on keeping up, building new homes for that demand. So demand remains highly pent up. There is a lot of demand out there, not just from us as investors, but also from those normal household formations. They are keeping home values high. It is feeding into this supply and demand type scenario. A lot of economists, what shocks me sometimes when I read about, when I read economists and some of the things that they say is going to happen, there are some that believe that these higher interest rates are going to kill demand at such a level that there will be no demand and housing prices will plummet. Well, I'm here to tell you that I do not believe, and I'm not an economist, okay, but looking historically, comparing where we are today to where we have been, looking at the underwriting standards that have been in place for the past 15 years after the last crash, looking at what's driving today's lack of supply, and the fact that we have not met demand for over a decade, I think that what we are more likely going to see is a rising inventory. Rising inventory means that you'll read in the news, it's taking 4 times as long to sell a property that goes on market today as it was 6 months ago. What they won't tell you is that 6 months ago, it took 8 days to sell a house, and today it's taking 30. That's a normal market. That's a healthy market operating the way it's supposed to operate. It still takes 4 times longer, but 30 days is fantastic. They will tell you that homes are not going to go up in value as quick, that we are not seeing the same appreciation rates. What they won't tell you is that we're moving back to a normal market. I told you earlier, Dallas has appreciated at 22% year over year. Meanwhile, Dallas is expected to appreciate closer to 12 to 15. But you'll hear the story that appreciation rates are down. What you won't hear is that they still remain historically high. I believe that this is where we're heading. We're heading to a new norm, and we just have to get there as soon as we possibly can. I want to kind of show you what I mean by that. So this is just a simple, up, down, up curve. All right. And you can see at the top, January 1 is when we had interest rates in the 3s. We had amazing appreciation. We had demand through the roof. Things were moving in 1 day, 2 day, 3 day. I mean, it was amazing. It was difficult even for us as investors to sometimes to get started because houses were gone so quickly. They're talking about how Buyers can't buy houses because investors like us are coming in and buying homes with all cash offers. Doesn't matter what the price is. I'll beat it by $1,000 because we saw the value. The market has tremendous value. There are, from the hedge funds to the iBuyers to the individual investors like us that are actively looking for deals. That doesn't even include the homeowners. So that's where we were January 1st. In early March, we started this dip. And what I mean by the dip, this is all about the psyche. This is not indicative of anything other than, I'm going to call it like almost like the fear cycle. This is our psyche. This is not indicative of anything else. Early March, interest rates continue to go up. The market is not cooling down. Unfortunately, the news I just gave you a second ago is what we're hearing. The news cycle is negative, 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 but they're not telling us that it's only negative from these super highs that we had, that we continue to remain strong, that the market remains strong. So that's early March. The psyche is going down. May 8th, I picked this date very specifically. On this day, yeah, there was some very negative news that came out that day economically. On this day, we saw site visits to our website go up. We saw this trend where we were getting more visits than we had had in the past. That trend started going up, but the number of investors that were outreaching saying, I'm ready to talk to somebody now, went down. So confidence went down. Need for understanding, need to know what's going on, need to consume and figure out what's happening and what steps do I take, it went up. So to me, this represented, on May 8th, really represented kind of the low point of fear, the low point of lack of understanding. And let me make sure that we're clear on fear, because I love fear. Fear is not a bad thing. Fear is a bad thing if we let it be a blunt object. Fear is a bad thing if we let it just clip us down and say, I'm stopped dead in the tracks. Fear is not a bad thing if we let it be a focus object, if we let it be something that sharpens us, that makes us ask more questions, that makes us be really, really clear on what our expectations are and how we're going to get there. So for me, and make no mistake about it, y'all, I mean, I've been doing this for 2 decades, but there were many moments when I walked in the doors and sat down with Kent Sr. and Brett in our executive meetings and said, yeah, I'm nervous. You bet I'm nervous. I mean, who wouldn't be? If somebody says, I'm not fearful at all, they're going to lose their money. Somebody that says, yeah, there's some fear here, man. I need to know what's happening. I need to make sure that I'm clear. That's when you're using fear to your advantage. Use it as a focuser. Don't use it as a blunt object that's going to kill us. No, that stop all our momentum. Absolutely not. And this that May 8th represented the day where, for us anyway, I felt like we were at the bottom. And now as we're moving back up, what we are seeing on our side is we're already seeing greater demand. We have over 40% more right now inquiries and one-on-one conversations with new investors. And we've even seen a massive uptick in existing investors coming back around saying, yeah, I'm ready to begin review and hear more, see what you guys are doing, maybe start looking at some houses, and including those that say, I already get it. I've been with y'all for over a decade. I want to see houses now. Let's see if I can't make some moves now and lock in, because I know my money is going to be more expensive in the future. I know that what I lock in today, I'm going to capture appreciation going forward, but I'm going to lock in my cost right now at the one point in history where I really firmly believe rates are going to go up and it's going to be more expensive. So we're starting to see more of that right now. It's the upslope. Now, let me show you where we are. I'm here, but I've been out in front of this. I've seen some of these things happening. I've been through these markets before. I went through the same questioning that everybody else does right here on May 8th, man. I was saying, I'm not 100% sure what's happening. I had many nights where I would, wake up and take notes on a pad because these are questions going through my mind. None of this is, I'm not questioning what I'm doing. I'm not questioning where we're going. Heck, I've got properties. I was just telling somebody earlier, had a commercial property I sold this week. And as soon as it closed, I turned right around and said, let's go. I need to find that property I can put this back into. I don't want to sit in cash. There's no amount of interest that I can get from any accounts out here that are going to be better than me getting into a property today for what I'm going to make. Not even lending the money myself. I'm not interested in lending for somebody else to own a property. At this point, I want to be in physical assets as quickly as possible. And I feel the urgency of needing to do it before interest rates hit. So I'm here at this new normal. This is where my mind frame is. And I believe we as investors, this is the cycle we have to go through. You know, it's euphoric. Things are going great. I don't have a lot of questions. Now there are concerns in the market. There's a lot of movement. There's a lot of things happening, and I need to be sharp and focused. I need to be sure of what I'm doing before I move forward, because what's going to occur is the new normal. I got to give Heather Harris, who y'all saw her earlier introducing, a lot of credit for this, because this is a concept that she kind of walked me through. She really helped me get clear in my mind, even what I had been dealing with, and helped me identify this May 8th date, because she's on the back end of our marketing, has all the data, and really, kind of helped me focus in on, there's that word again, focus in on what I needed to be looking at and what I was seeing. All right. So expectations, short, long term. I'm going to stop right here. I know that I am, I'm not sure how many minutes I'm in on this thing. All right. So I've been going for a while. Listen, I need to make sure I'm clear with everything I'm fixing to say from this point going forward. I'm an investor. I buy homes. If you've listened to my personal story, and those of you that haven't ever heard my personal story, I've lost my ass. Excuse my language. I've made so many dumb mistakes as an investor back 2 decades ago that when I talk, I do talk from experience. I've done a lot of dumb things. And when I should have been fearful, I had no fear. I had no respect for my money whatsoever. I was just throwing it around. It wasn't valuable to me. I just thought, I know what I'm doing. I'm just going to go buy some real estate here and there. I didn't ask the right questions. I did not find the right partners at times. And some of my mistakes were very costly. Here I am in 2022, and the decisions I made back in 2005 through 2008 kind of have slowed down where I could be today. So I want to be clear with everybody. I'm not giving you financial advice. Do not take it as such. I am speaking to everyone today as an experienced investor. I am not an expert. I have experience. That puts me ahead of the game in some instances and in some ways, but that's what it is. Don't take what I'm going to tell you today or anything I've already said today as that's the advice I need to follow. You need to ask questions. You need to move at your own pace. One thing I'm not trying to do today, and I never do, I'm not telling you that you need to go put something under contract right now today, or you're going to miss out on the opportunity. Not at all. I'm telling you that you need to be asking questions and moving forward. Now, your moving forward may be slower than somebody else is moving forward, which is perfectly fine. You need to move at your pace. But standing still, in my opinion, as a real estate investor, may not be the best option. Sitting in cash, it's not an option for me. For me, I'm not prepared to sit in cash. I am prepared to own assets as quickly as possible and at whatever rate I can get, including if I can negotiate a good 5, 7, or 10-year ARM, I'm going to grab it right now because it's going to be lower than what I can get from a 30-year mortgage. And I anticipate in the next term, before that thing matures, at the rates being lower and me locking in then at a 30-year mortgage if I choose. I am highly confident that I will continue to see an appreciation of anything I buy so that there will be a greater spread there. I will capture that yield at that time if I choose to pull out equity or I choose to let it grow. When I ultimately sell whatever I buy today, I anticipate my IRR being well above my expectations. You get to set your expectations. I set mine. If you're watching today, I don't want you to hear me like pressing the gas saying, you got to go. No, what I want you to hear is you've got to go on getting the answers you need. You've got to get moving forward on asking the questions you need to ask. And when you are comfortable that you've got your questions asked and you've got a plan and you're able to hit your short and long-term expectations, then I encourage you, wherever that is, whatever it looks like, to do what you need to do, to make the moves you need to make. Okay. I don't like high pressure. I'm not a high pressure guy. So I want to make sure everybody understands that. All right. So short and long-term expectations. Where are we at here? So for me, look, I cannot emphasize enough. Don't chase yield. Do not chase yield. This is a different time period than where we were even 6 months ago. I anticipate, due to housing, the cost to build a house today, building materials alone, is 43% higher than it was just four short years ago. It was 42% less expensive to build a house. Materials are going up in value. They continue to go up. It costs more to build a house today by 42% than it did 4 years ago. I anticipate that continuing. That is a trend that will not stop. Will it blunt a little bit and come down? Possibly. Not grow as fast? Possibly. But already this year, with all these buzzwords we keep hearing about supply chains and building materials, lumber costs, lumber price, all these different things, it's just making the building of a house more expensive, which means the asset you own is more expensive to replace. It takes its value up if you take care of it. So I do anticipate housing remaining very strong and going up in value. Every market's going to be different, but I believe we're well positioned in the right markets and in the right areas of these markets. Don't chase yield. This will be a get your money in and allow time to take over. More than ever, right now, this is something I've said forever, and it is the exact way that I try and invest. I invest for a return of my capital. I want my money back. That's all I care about, number one. I just don't violate the rule of don't lose money. I want my money back in the end. I'm perfectly willing to shave the yield now. I'm perfectly willing to do a negative cash flow for the right property that's going up in value. That's me. I have bought those houses before. They make sense for my portfolio. And it's because I'm not chasing yield. I don't care about the higher cash flow on paper right now. Those almost never pencil out in a market like this because the greatest challenges are faced by the more challenged areas of a city. In all cities, lower price points, they tend to not fare as well in a down economy. So I'm not looking to invest today in areas that I think are not going to appreciate as high. I'm not interested in investing in areas that I think that the demand from a resident to live in that area is going to go down. I'm not interested in investing in an area where the opportunity for a resident to meet their goals and their expectations from a rent standpoint and a length of occupancy standpoint is low because they're facing greater challenges themselves. I'm just not up for that. I want to be in an area that I believe has the highest probability of a resident remaining, being able to increase their rents even slowly, even little nominal amounts because their incomes are increasing and they want to stay. They want to stay put. I want to invest in that area because no matter what the yield looks, my IRR when I go to sell this property is going to be massive. It's going to be through the roof for me anyway, in my estimations later, because it will have gone up in value while a resident has very dutifully, followed their piece of this and they have just paid their rent on time. I have been smart with that rent and used it to reduce my principal. That's going to give me my greatest return. So that's what I look to do. One, return of capital. Once I've done that, now I want to make a return on capital. There's 4 ways that are going to affect your yield. Number 1 is maintenance. Number 2 is vacancy. Number 3 is interest rate. And number 4 is going to be the rent. So you need to put an eye towards the first 2, especially because if you can maintain a high occupancy, if you can have very little vacancy, if you can reduce maintenance, especially over those first 3, 5, 7, even 10 years, and the highest probability of very little CapEx expense during that time frame, well, you've reached the first part. You've done your job on the first part. Now I have given myself the highest probability of the best yield I can get. Now, lock in the best interest rate you can while you can. Then let time increase your rents. Rents will catch up. They lag behind values. They don't go up at the same rate values do. But I think there's room in all of these markets as income goes up for very nominal and expected rent increases. Be patient. That's the biggest thing I can tell you. Don't chase yield. If you're looking to go and you're looking on a piece of paper saying, man, this thing is going to be a home run, it's out of the park. There's, I am ecstatic. I can't wait to buy this house because I'm going to be making a 20% return every year. And believe me, I've seen this stuff from other companies, even right now as we speak. And I'd be lying if I said I don't want to be overly dramatic. It just disappoints me. It just disappoints me because I know that there's a lot of investors that just are not showing enough fear right now. And by fear, they're not asking enough questions. They're just jumping at yield on paper, and yield on paper rarely translates to, real world results. All right. So be patient, invest right now in the best property you can find, the highest probability of no vacancy, the highest probability of no maintenance. And if you're watching this right now saying, well, you're just describing your company, you bet your ass I am. Of course I am. This is what we built it for. I made so many mistakes. My dad, my brother, they both luckily didn't make quite the same mistakes I made, but we all three understand that we're building a company to prevent people from doing any of the dumb stuff that, well, I guess that I did. We're trying to make sure that we answer the questions that investors have, which is protect your assets, man. Protect your income, protect your money. Get it into the best asset you can with the highest probability of maximizing your return. But before you can get there, you got to make sure you're going to get it back. That's what we're looking to do. That's my entire portfolio is all about. I want my money back. If this whole thing goes to heck in a handbasket and I gotta dump out, I'm getting all my money back. I'm no worse for the weary. I made my return while I owned them. And I got my money back. That's what I'm looking to do. When I bought cheap, when I bought highly challenged homes in highly challenged areas, I lost my backside during that recession. So I just wanted you to understand that I'm passionate about this. I'm passionate about sharing what we're doing. I'm super excited, but you gotta, more than anything, you just gotta be careful. All right, here we go. So when we put this out, that we were gonna do this webinar, and look, I'm all in for doing more. You guys be sure at the very end of this, we're gonna have a QR code. I'm gonna leave it up. You can scan it with your phone to tell us a survey. If you want more of this kind of stuff, let's do it. I'm all in. I'll answer questions all day long and do anything I can. These are some questions, kind of a variation of the questions we received when we first got started. And I think I've answered a lot of this, but I want to make sure that you guys understand where I'm going with this and put some nicely worded answers, some really clear and concise. So why does it make sense to continue to buy right now? Number one, if you have capital, if you have access to capital. So capital that, let me be clear. You borrow from a bank. This is the only investment that you can actually leverage from a bank to get into, unlike stocks and crypto and that kind of thing. There may be some other, exotic stuff, but this is a solid investment. It's been around for forever. Okay. So I can leverage the bank and they will give me money. They'll do their due diligence, which is great. That's third party due diligence. So now they'll do due diligence. They don't want to lend a loser. They want to make sure that they're lending on winning homes with winning investors, with winning programs. All right. With the whole idea that they're going to get their money back. They're returning for, they're investing for return to capital. So right now you can borrow. Home prices, I anticipate, will remain strong. They have been super resilient so far this year. You have not seen them come down, and we've been through some massive rate increases so far, and demand remains exceptionally high, still above normal, because home pricing and appreciation and days on market, they have not returned to a normal market yet. They're on their way. They'll get there, but not yet. They're still at historic highs. The price to build a new home continues to escalate and go up. The cost of money to borrow and get into a home appears to be going up for the near future. And rents have plenty of room to continue to grow. Even if it's small, they continue to grow. So anything you buy today, there's a high probability, provided you paid attention to what I just said a second ago, provided you're buying in high demand areas with good providers, good companies. Maybe you do all this work yourself, which is fine. You know what you're doing. You get it. You take the right steps to protect yourself. High probability you're going to win in the long run, the 5 to 7, the 10-year term that most investors invest for, it still is a positive right now. You're still moving in the right direction. So, where do you see the market headed? What's going on? Well, you got it. I think that there's going to be a little less demand, which there's going to be a little less fighting going on out there for us. I think that there's going to be less of the, you got to pay 25% above list price to be able to get it. I think that's going to end. I think that's going to go away to a little bit in some areas. But that's where I see the market headed. Same thing with the trends you see and what's coming next. Look, what's coming next is a new normal. I think rates are going to be, mortgage rates are going to be high for a little bit. I think 12 to 24 months. Once we begin to see that, hey, this is where this is going to go, and the economy is going to slow down a little bit. There's all different ways they track and call things a recession or whatever. I get all that. I'm not an economist, but once we enter that particular phase, I don't think it's going to be very long. I think that it's going to be like 6 of the last 7 recession markets where it's going to be over within 2 years. And as we exit that recession and the economy begins to pick up steam, I think that the mortgage interest rates will be below where they are today, or where they're going to be 6 months from now, which may be a half point higher or whatever. They could be right back to this level 2 years from now and coming down. That's a great thing for us. That's what we want to do. Right now, I want to lock in. I want to get my money active while I can. I don't want to sit on the side. I want to get into assets that are going to go up in value so I can capitalize on what's going to happen in the next 2 years. I do not foresee vacancies increasing in our portfolio. Will they increase in other parts of cities? I don't know. I can't say for sure, but I do definitely believe that areas that are more challenged, areas that have fewer jobs, access to fewer jobs, harder access to food, harder access to transportation, these parts of the city where values tend to be lower, rents tend to be lower, appreciation tends to be lower. I think that, yeah, we will see some turnovers and vacancies there. Understand we haven't built enough. We just haven't. I think we're 4.5 million homes behind since 2010 on basic consumption. And everybody, a renter or, a new household formation that's not a renter, that's just entering the market, in general, they all need places to live. I think that rents are not going to increase as high as values have. And I think that companies that try and push rents too much, investors that try and push rents too much, they'll have vacancies, and they'll have longer vacancies. They may get what they want in the end, but if you can get 10% less on your rent and rent it today, but you want to hold out for that last 10%, it could take, a while to get there. That I definitely see that coming as, there's just, as vacancies do increase in some areas and some price points. Housing inventory levels, I think I've already answered that one. I know for sure. Look, they're not, here's the deal. If you're a homeowner and you're going to sell your home, now appears to be a really nice time to do it. There's high demand. But once you do, where are you going to go? Now, what are you going to do? Because you're in the same market as everybody else now. Now you're all fighting for something else. Are you going to buy, a new build? You got to do that well in advance. That's going to be 12 months, 6 months, 12 months before a new build is ready to go in most scenarios. I think the only place where houses would be selling and it wouldn't be immediately replaced with demand for something new is the generation of homeowner that's looking to sell their home and move in with their children or move to a different type of facility, a different phase of their life, whatever. They don't want to own a house anymore. But in most scenarios, when somebody's selling a house, they're either going into the renter pool or they're going into the new homeowner pool, and there's high demand for both right now. Yeah, I think I've kind of answered this one as well. Look, y'all, I've just been around this thing a few times, and I've invested in different classes of homes in different neighborhoods. I've tried to do a lot of things. I tried to at one point I bought a whole neighborhood and tried to renovate the entire thing and bring it all up a level. But I was doing it in an area that, as I said earlier, that it just didn't have access to transportation. There wasn't good access to jobs. There was no food around there, from grocery stores to fast food, that kind of stuff. It wasn't necessarily a food desert, but it was just tough. It was tough for any resident that was going to live there. And, unfortunately, those parts of towns exist today, and it was highly affordable for me to get in. It didn't cost me very much as an investor. And the way I looked at it at the time when I bought this neighborhood was, I'm going to come in here and there was 12 homes. I think they were all duplexes. I'm going to buy these 12 duplexes. It's relatively little use of capital. It's low cost for me to get into this. And big upside if I make it work. Well, unfortunately, I didn't make it work and I lost everything in that deal, pretty much everything. So my point is that sometimes these low barrier of entry investments carry the greatest risk. You know, we convince ourselves that because it's a low barrier and it's not a lot of money and not a lot of capital, it doesn't matter if I win or lose. It's no big deal. The reality is it does matter. You're not getting your capital back when you take massive risk. It doesn't feel very risky because it's not a lot of capital. But whether it's $1 or $1,000 or $100,000, it doesn't matter. If it's highly risky that you won't get it back, you might as well say it's gone once you make the investment. So be smart. The shifts that we're seeing is that investors like me, and I'm not going to say the smart ones, don't hear that. That's not what I'm saying. Just, I've been around this. I have experience, and I'm using my experience to tell me I want to buy the best asset. I may only get to get one. I want to buy 2 houses because it reduces risk, but I'm at greater risk because the houses I buy are going to be less expensive. I would rather buy one property and I'll keep saving my money up. I'll buy another one the next year and the next year, so be it. But I'm going to dollar cost average across the boards. I'm going to build my portfolio with assets and companies and the highest probability of getting my money back. My money is safe. Then I'm going to look to maximize my return. I'm going to take every step I can, try and lower my insurance costs, try and keep working on driving my interest rate down, get into an adjustable rate mortgage that I can refinance at the earliest possible rate when rates are lower. I'm going to look to have a management company, again, this is what we do, that's going to raise rents, but going to keep it occupied. Don't force somebody out. I don't want a vacancy right now. I want it occupied with a paying resident that wants to be there. Then we'll raise the rents, little bitty amounts, make it something that they can swallow every month, but it's more for me. It increases my return. That's the shift I'm seeing. I think more investors who will be successful investing right now are going to do this, as opposed to those that look to chase yield on paper and try and buy something cheaper, or try and, the yield's not enough, my monthly cash flow is not enough. Look, if I'm buying something in Texas right now and it's going up 22% year over year right now, and they expect it to remain double digits, which they do because there's more people moving to Texas than any other state. So if that's what's happening, I don't really care if I lose $100 a month for the next year. Doesn't matter to me. I made 6 times that in value. And then when I get to raise rents and I can raise them by $50, well, I've just cut that in half for the next go round. And if it only takes 2 rental increases for me to get back to where I'm actually cash flowing, and in that time, maybe I'm able to refinance and drop my interest rate. Now I'm actually driving more money into my investment. And the whole time it's going up in value. We just had a great I'm not sure if Dan's on here. I can't see all the names right this minute, but had a great post put in Bigger Pockets. I'm all over Bigger Pockets all the time. If you're on there, feel free to look me up and connect with me there on Bigger Pockets. But one of our investors has been updating his investments as he's gone along, and he put a property in there almost 3 years ago, a little over 2 years, about 2.5 years ago, and he updated it recently, and it's gone up in value across the board. So he uses all the different sites from Redfin to Zillow to Realtor.com, all of them to compare values. And it's gone up almost 40% in 2 years in value. He's getting a higher rent than he started with 2 years ago, has had less than $500 maintenance cost in 2 years. He went from 1 house to 7 houses in the portfolio with us. And he was just messaging in there that he's just following a very simple formula. I expected and want to build a portfolio. They know what I'm looking for. They put it in front of me. Here's the calculations. If it meets what I want, I buy. And it was never that I had to make X amount of dollars in cash flow. It was that I want a solid, consistent, reliable investment. That's what we're trying to do. That's what I'm looking for. I think the investors that are going to have the greatest success are going to do that over the next couple of years. Okay. All right. So open Q&A. Let me get my Q&A open here and kind of see what we've got in here.
And
So,
hey, Chris, I just put a note out to everyone that we understand we're coming up on the top of the hour. So if anyone needs to drop off, we'll make sure to send the recording out. But for anyone who's able to stay on, we'll get as many of these questions answered as we can.
okay, so this, I mean, we should have known that there was no way. Once I get talking, I get so excited, I just keep on going. Look, so let's do this. I'm gonna talk for the next 10 minutes and that's it. Those of you that are hanging out with us, 10 minutes and we're done. That way you can get back to what you need to do. If you need to drop off early, go ahead. And I will answer any question, guys. We'll do all these by email if we need to, but I'll make sure that everything gets answered. So, Karen Rumi asks the outlook on rent prices in the various cities that we're in, and it seems the rent increases are not on par with appreciation, and she's 100% correct. You're right. And I think I just said a second ago, they're not. They don't. They lag behind, and they will not. I mean, appreciation has been so astronomical over the past year that there's no way rents are going to catch up with that level, but rents are going to go up. Historically, as inflation goes up, rents increase. As people get raises, as incomes go up, rents will go up. And we as a company, we do this on a one-off basis. This is not this thing where we say, well, all rents should just go up by a percentage. No, we are in each house trying to see what is the market value today, what's a brand new, newly renovated home renting for, as opposed to this is a 6-year resident that's going to sign a new lease. You know, we try and make sure that we get the rents proper. It may not be what a brand new house is today, but it's certainly going to be proper for a home that's been occupied for 6 months or 6 years. So that's where we're trying to go. I do see rents continue to increase. I'm not a Tom Leonard. I think you're asking if we could see a distribution of rents. Okay, we will work on getting that for you to see what I think what you're asking is based on the rent level. What are we seeing? What are we seeing the increase of that? I guess that's what I think that's what you're asking, Tom. I'll make sure that we get that for you. I'm trying to read back through here. Somebody asked on the $80 million that gets sent out, how much on average does the owner get in monthly cash flow? So here's the deal. The one thing I don't have, the piece of data that we do not keep is your specific rate that you got and did you do a 15-year or 30-year mortgage? What mortgage information? We don't have that. So I'm not able to tell you exactly what the monthly cash flow is. I can tell you that what we anticipate it to be when we are doing evaluations on the front end, and we anticipate cash flows on most of our properties to be anywhere from $150 to $400 a month. And the reason why I say it like that is a lot of investors, they want to take out a lot of expenses that are not going to occur, and it drives that cash flow down. And if you want to hold off in your no big deal fund, as I call it in my book, go ahead. But most properties, when you account for the lack of expense, they're going to be cash flowing positive. I don't have any way to be able to tell you exactly what it's going to be because I don't have insight into the actual data of how people are setting up their mortgages. Okay, yeah. So Matthew Diano asks the percentage of our sales to investors all cash versus investors that are using some form of lending. So for today, it always fluctuates, and it's going to kind of this thing that goes up and down. But right now, roughly 80% of our investors are doing some form of leveraging. Now, a percentage of them are leveraging inside of their IRA. A percentage are doing 1031 exchange, where they're doing some cash and then some lending to make sure that they get their levels right to keep their 1031 proper. And at times in the past, we've seen 70% that invert, where 70% are cash and 30% are leverage. But right now, we're still seeing about 80% of our investors that are using some form of leverage as they're coming in. Tom Leonard's asking, so Tom's asked, of the 4% maintenance, we keep getting questions in, he'd love to understand the breakdown of expenses for newly renovated properties versus properties of renters and turnovers, or something along those lines. And he's right. So look, let's be clear. The 4% is a maintenance is a average. And so in order for an average to occur, there's got to be higher and lower. and I don't have the data here in front of me, but Tom, I'll make sure that I get it for you. So what we have is we know that a property in year one on average and on median, so the median is the exact middle, of course, of expense. I know that on that median, it takes year 6 before homes managed by the Memphis side of the company reach 4% of rent. And that's of the original rent, because I have no way to be able to calculate it for what its current rent is. And we know rents go up. But before a homeowner on median reaches 4% of their annual rent collections in maintenance expense, and that includes move out, but it does not include where the owner sends money in. And we know that in some cases, owners are sending money in, but not everyone. So not every case, but we know that 4% of collected rent is not paid out in maintenance until the 6th year of ownership on the Memphis side, and it's the 5th year on the Dallas side. And then after that, it remains around that 4 to 6% somewhere after that. And most of that, as you noted, Tom, you're kind of asking here, is going to be due to a turnover expense, which really drives up that year's cost. So an owner might be paying 0 to 1% for the first 5 years, and then pay 12% in the 6th year when they have a move out or something along those lines. You look back across it, and it still averages out to be less than 4% annually. So just so we're clear, we do have that. We got great data on that, Tom, and love to share it with you. All right, so I have an anonymous question of which city state do you see poised to be very well in the coming months, years? Look, I'm in them. We are in the Southeast. I think is going to do the best. Anywhere from over there, Texas, up through Oklahoma, across, below the areas where you get heavy winters, all the way down through the South. We stay off the coast. We try and stay away from the salt air, but we won't always do that. There's some really great markets down along the coast that we may move to. But for now, we're in markets that are in the middle of the country that are growing fast, that we're not seeing additional expense of winter, and we're not seeing additional expense of salt wearing the roofs and the systems down. So we feel like we're in the right spot. We feel like we're in markets that are going to continue to go up. They remain in high demand. They remain on the top 20 cities to be moving into, and they remain high in appreciation. But nothing, I don't think, is going to beat Texas. Any city in Texas is going to blow the doors off anywhere else as far as appreciation goes, just because there's so many people moving in there. They can't keep up with building fast enough. I love each of the markets. I love Oklahoma. I love Little Rock. I love Memphis. I love Northern Alabama. These are markets that continue to remain strong in growth. People are moving into. So, all right. So Jeff Ledbetter asked a great question. I think I'm probably reaching up on my time, but I'm going to try and answer a couple of these real quick. Jeff asked a great question of how do we process going into a new market? How do we establish property management, find reputable contractors, et cetera? Well, the number one, Jeff, is that we just spend months doing it. Long before we go into a market, we've already been there dozens upon dozens of times, and many people from our company have visited, begun to build relationships. We often enter a market offering the opportunity to manage existing properties, because we know a lot of our investors have bought in other markets. And so we'll go into a market, offer our management services, pick up a set of homes that begin to produce revenue. Now we have people in the market that are already buying. And now, because we visited that market so many times and met with contractors, we begin with a small group, and we're super loyal. We start with a small group and say, we're going to keep you busy as much as we can. And then we just let it snowball. So we don't go into a market looking to buy 50 houses the first month. It might be 3, might be 5. We're super slow with releasing them. I know many of you guys have been frustrated that you want us to release houses faster in some of the markets we've gone into, but we want them rented first. We want to make sure that we're able to produce what we say we can produce before we, start selling houses in the market. So believe me, we spend a lot of time researching, meeting, and visiting before we go. Frank M asks if I ever see REI Nation in North Carolina. My answer is short, yes, but I don't know when. We've absolutely researched markets in North Carolina, South Carolina, Kentucky, Georgia, Florida. and that would really kind of create that Texas to the eastern seaboard, south of the heavy snow lines. That would create the heavy winters. That would create, kind of a filling out of the map. When, I don't know. Here's the one thing I'll tell you for sure. I'm not going anywhere. We're not going anywhere until we know that we're able to produce the same cheeseburger in each of those markets that we produced back in Memphis and Dallas. I think you guys get the analogy. We're not interested in having differing results based on where you go. We want a very consistent and reliable experience, and investors to have a very varied, portfolio. Today with 11 markets, we've got it, but we will be looking to go elsewhere if we want to. If it makes sense, we'll go. Okay, James Martin says, I love seeing the KPIs that you gave earlier. Yeah, man, the house is under management. Helps if your portfolio is moving in lockstep with the whole group, if you're going through a period of good or bad luck. I totally get it, James. And yes, we try and produce that on a quarterly basis. But even like this webinar, we've already said to ourselves that if it's needed and wanted, I'm going to go on. I love talking. As y'all can tell, I've been on here an hour and 15. I love doing this. So absolutely, we'll get more regular updates. Chris Coleman, no, he's asking, are there any markets we expect to go down over the next few years? No, there's not. We have a team that is going to bust our backside to make these things perform the way they're supposed to perform. I don't see anything that makes us hesitate. We absolutely slow down in markets as we see trends, which is why you don't see houses come out as quickly, maybe say like in one particular market over another. Maybe you see that they're not producing as many houses right now out of, I don't know, as an example, you say, well, there's not as much coming out of Memphis right now. I'm looking to buy. What's going on there? We fluctuate based on what we see happening, but none of these markets are things that we're scared of. But believe me, we're not about to buy things that we're not confident that we can create a good return. Okay, so Paula's asking, do we have a breakdown by market, a full market value of the properties and the average rents? I can get that for you. It's something that we'll produce as a KPI. It's a great question. It's not anything that we keep up with, but if it's interesting and needed, you bet we will. Okay, so look, wow, they just keep coming. I have to cut this off. So I don't have to cut it off. I'm gonna do this. I'm gonna record it. I'm gonna answer them. Okay. If you need to go, there's we've had like 9 more questions jump in here. I'm gonna answer these. And this will be in the recording, to go to the very end and hear these last questions. Heather, I'm gonna keep going. We've still got a lot of people here. I want to make sure I answer these questions and do the best I can. Okay.
Okay. Wonderful. Thank you.
All right. So, Pete Cordero's asking, he would love the thoughts on how to approach investing due to the following: higher rates, lower cash on cash return. Should we lower expectation and shift focus to ROI? In other words, look more holistically at returns. Man, Pete, you're asking a question that I think is so valuable to everybody. And you're speaking my language, because I learned a decade ago to invest the way you just described. I quit investing for the short-term monthly return and started looking holistically at the whole thing. I didn't want the headache of move-outs. I didn't want the added expense of vacancies. I didn't want the surprises. So I said, look, I would like to buy my own houses that had less maintenance, that had less deferred maintenance. I was willing to buy houses that I lost money on a monthly basis, but I was doing exceptionally well on a annual appreciation. I started buying houses that were more expensive, and the results of my portfolio speak for themselves. The value in and of itself is massive. And I didn't lose money every month getting there. It cost me a little bit more, yes. And sometimes I've invested, oftentimes I pay all my principal off quickly. I don't take cash flow, but I had to construct deals that if I did take cash flow, there was less of it there, but that was okay because of the process that I was going through. I wanted the best asset possible. And I think that more investors should look that way. Monthly, who cares? It doesn't matter. As an investor, my advice is not to be spending money on a monthly basis anyway. You should not be taking monthly revenues and saying, well, I'm going to be using this for this, or this is, Absolutely not. Every dollar you make from your portfolio anyway should be going towards reducing principal, because the interest is the number one expense you pay, and it always has been. Even when it was at 3%, it was still the highest expense we had. So I'll be taking all my cash flow anyway and shoving it into paying this off as fast as possible and owning it so I can own all of the rent. All right. But I do think, that Pete, you'll get me going on that one. It needs to be looking long-term. So there's somebody's asking, do we allot a certain amount of money for marketing our properties? I think you're asking marketing or listing photos. Hey, look, it's not a certain amount of money. We'll do whatever it takes. I mean, we'll do, every single thing we have to do to be able to keep our properties occupied, from street signs to direct mail marketing, to online marketing, to Facebook marketing, to running ads, anything and everything. We do it to get properties occupied. Debbie Guyton. Yes. So Debbie's asking me, and Debbie, been with, if you don't mind my saying, Debbie, you wrote in and you've been with us for since 2010 when she bought her first houses with us. And she's asking, does it make sense to review and see if the homes are in desirable areas or not? Or look, Debbie, we have had a lot of investors this year. This has been a big trend where investors are saying, I'm going to sell my portfolio and 1031 into better homes in better areas. And there's the good news is that there's great demand even for your portfolio today. We can absolutely assist you in making that happen. In some cases, we want to buy houses back, allow investors to capture their appreciation, and then we will either do the needed renovations and bring it back to market for another investor, or we will take it and leave, keep it for ourselves, or sell it outside. We can absolutely assist you. But you asked a great question. The first thing you have to do is let's get a review. Let's help you, Debbie, find out if that's where you need to go, because some investors have said no, and other investors said, yeah, let's get into something different. Let's get into something else, and happy to help. That's what we're supposed to do. Okay. So somebody, RG, is asking, what's the minimum term you would have to hold with us? And are you able to sell, and do you own the home in its entirety? RG, thank you for asking that question, man. Number one, you don't have to hold it. It's your house. You own it 100% solely. It's yours. You do not have to use our management company. If you find value elsewhere, you don't have to use us. So it's your investment property. How long you hold it, what you choose to do with it, that is 100%, your choice. We're happy to help. We're happy to give you our, for lack of a better word, our advice, our, kind of what we're seeing. But I would tell an investor that to maximize your return, you would want to hold 5 to 7 years. But look, I'd want to hold it as long as it's occupied with that first resident. As long as I have no vacancy, I would look to hold it as long as I could, but it's your choice. It's your property. You're able to do whatever it is you want to do. And we're able to provide any services you need along the way. And Paul is asking, do we have the services to facilitate a 1031 exchange among investors? I'm not 100% sure exactly what you're asking, but Paula, we know who the 1031 exchange companies are, and we're happy to introduce anyone to anybody that can assist you. Kind of back to that last question, whatever it is you need. Okay. Matthew Diano's asking if we can get KPIs out by market. Yes, we can, and we'll do that. Some of the stuff I gave you earlier is certainly market specific about values and what's been happening with them. Love to get KPIs out because we keep it. You bet. Absolutely, we'll do that. What is the Rick? Okay. I want to make sure I pronounce the name correctly. Vamshi is asking, what is the recommended minimum amount of cash to consider a safe investment? I'm hesitant to answer the question straight up the way it's asked, because look, that would be like me giving like true investment advice. I don't know. I don't know what it is for you. I do know that I would recommend you figure out as best as you can what feels like a safe, wise investment, and then figure out back in how much do I have to put in to get into this investment. That's where I would go. But I can't answer the question on what's the minimum amount of cash to consider it a safe investment. I just don't know. So much of what makes a safe investment is how was it renovated and how is it managed? Because the consistency of holding down maintenance and keeping a property occupied makes an investment inherently safer. So, that's kind of a tricky question. I love that you're asking about, I just can't answer it quite that way. So Brett Johnson is asking if REI Nation would ever consider a type of seller financing option for investors. It's a great question, and I don't know. I know it's not on our board today. It's not something that we're looking to do today, only because there's a lot of regulation, and we want to make sure that we keep nice arm's length between what we do and what we provide. I own the home, so we're selling them. And, you know, I like being able to tell somebody my opinions based on experience. And I just don't know. I don't know that we can or would, but it's certainly something that we might. We're looking to make this a more circular transaction. So giving investors the ability to buy a home, have it managed, one day be able to sell a home, and roll into something else and have it very circular, holistic, close the circle on our end. Would that include some option of being able to provide seller financing? Possibly, but it would take a lot of time and thought on our side, because we want to make sure that what we do is always in the best interest of the investor. Michael Fisher's asking if we stay away from states, or if there's states we love because of their tax numbers. Deep question, man. I don't know. We don't go a lot into the taxation side of it, although I don't believe any of the states were in tax real estate entities. To how level I could be off on that. I'm going to be off on that. I'll make sure I don't answer things too straight up on that. But look, I do like Texas, and people are going to say that Texas has these really high real estate taxes. But let me tell you the flip side, the benefit. People, they downplay Texas and say, oh, the taxes are too high on real estate. Let me tell you something. Real estate taxes are how Texas funds their road and infrastructure and school improvements. And so one thing you got really good in most of these areas we're in Texas: good schools, good roads, continued improvement. It doesn't happen any other way. And so we may pay high, but it's what attracts people coming in. It's what drives demand up. It's what makes these properties go up in value. So I often tell people, if your taxes are going up, so is your value, especially there in Texas. A little side off point. So Frank M says, head to North Carolina and Georgia. I love that. I'll let you know if we get there. We're absolutely looking at it. If you would like to, Matthew Diano's asking, if you'd like to divest a specific property in my portfolio with you, is there a process program, abs, to sell it back to REI, or another investor? Absolutely. 100%. I like that you're going towards, you'd be interested in saving the realtor commissions and other fees this way, which you would save some, but it's not anything that we would do at no cost. There's time and expense there, but it would be much less expensive than going the other route, 100%. And we're always aware of trying to keep costs low for investors. So 100%. You would connect with us, and I believe Blake Clothier is heading up that program for us today. Blake's a great guy. So let's go through here. James Martin bought 3 from another investor. So James, I'm thinking what you're telling me is that you bought 3 that one of our investors sold recently. James is a great investor here in town, a guy I've got great respect for. Been he and I, we follow each other a lot, especially through social media. I don't post a lot of social media, but he does, and I like it when he does. It's funny. Just a great guy. James, I appreciate that, man. That's and hopefully they are great investments for you. Debbie, you can reach out to your customer service to talk about how to get your portfolio reviewed. We'd love to do that with you. So this is a great question. Justin Y says, how can I see a list of investment properties available from the different cities? Justin, man, this is what makes us, I think, unique in many ways. We only do business one-on-one. We don't publish our properties. We don't put it out there. You can't get into a bidding war with anybody else. It's a very, very relationship business. And we have great relationships. As you hear from a lot of this, the questions and the people we're connecting with, we have great relationships with our clients and investors that we do business with, and even other investors here in town. So we value the relationships that we build. If you want to see these, fill out on our website a form to get started with us and to have a one-on-one conversation. We're happy to make sure that we're a good fit for your needs as an investor. Make sure you're a good fit for our needs. And then we'll get those properties in front of you. Happy to show you all the houses that we have. We get houses on a daily basis. If they fit your needs, happy to put them out there in front of you and give you an opportunity to buy them. But we are a first come, first serve. but we don't allow bidding wars. The price is what the price is kind of thing. And we do that very much on a one-on basis. Make sure that you get focused in on what we've got. So Frank M's asking a very specific question. How many properties do I recommend you own before you put them in an LLC? And what do you do if they're across multiple states? And do you have a holding company and have various LLCs under that company? So super specific questions. Absolutely get an attorney involved there, Frank. For years, I didn't have my properties in an LLC at all. I held them in my personal name. Eventually, I got an LLC. I put all my properties under it. I did a different LLC for the state of Texas and put my Texas properties under it. I do not have a holding company that everything rolls up to. But I do keep my portfolios in separate pockets. I run those separately. I run them properly. But I would recommend that, look, when you get to a point where you've got an uncomfortable amount of equity, you've got some real value. You paid these notes down, or possibly you own, everyone's going to have their own number. It could be 3, it could be 5, it could be 10. I would look to get them into some form of entity to be able to provide some layer of privacy and protection. That's really all it's there for. So Kay is asking, she says she knows I'm not a big LLC guy. It's so funny, right after I just gave that answer. And you got 3 properties bought all cash. If we buy more, do we need another LLC to have the coverage an LLC gives? Look, I would, if you're buying cash, absolutely put them in an entity, 100%. And I don't. I've always held all my properties under one entity, under one umbrella. It doesn't, I properly insure myself, put it that way. So I'm not worried about lawsuits and that kind of thing. I've got good insurance. I keep it up to date. I've got an LLC that I hold things into. I'm not worried about any other reason to do anything bigger than that. So RG asks, he says, thank you so much for the answers. Do you also help guiding with IRA allocation for down payment? 100%. And we do have great experts that we can help align you with to help you get great answers. RG, happy to do it. Can't wait to help you get started, man. Or anything we can do. And Dennis Miller asks, do you manage rental properties for investors that were not purchased from REI Nation? Yes, with one caveat. They need to be in the right area and they need to be at the right level of renovation and performance. So we will not lower our standards. We brought on a number of properties from investors, and sometimes work needs to be done because I'm not interested in bringing something in and having to constantly fix things up. We want to get things right on the front end and get them moving forward. So happy to review that with you, Dennis Miller. Again, Blake Clothier, a great contact over here at the company. Call us, go online, ask for him. Happy to be able to assist you with bringing properties in. We'll get that handled for you. And then, so Matthew Diano asked a great question about challenging real estate taxes. We actually have people that we can send you to in each of the markets to help you challenge. It's not something that we publish out there. We don't push a lot of it. We do it on a one-on-one basis with our customer service. Oh, okay. I'm reading a different thing over here. Anyway, we've got those services available to you. And I want to, as I'm reading the notes over here, Jim Martin, I want to apologize to Jim because I did confuse him with another gentleman here in town. Anyway, Jim, I know that you are now. I see the name was coming across James. I was confusing it, but I know that you're an investor of ours. Look, I am. This is a privilege for me. I want to make sure that I'm clear with the last people that are on here, anybody that watches this. If you, this is a privilege for me to get on here and be able to talk with our investors and do this more. I cannot wait to do this again. I have a feeling we're going to do more of these. I'm going to go here. I know there's not a lot of you here at the very end of our webinar, but here is a QR code. If you're one of those people that's still on here and you want to download this QR code and take our survey, let us know what you think. We're going to put this back out to all the investors that joined us today. Happy to jump on here again. Hopefully I answered good questions. Hopefully I did not confuse anybody. We're here. We're excited. We're moving forward. We are growing. We are not in any way, shape, or form, slowing down. We see tremendous opportunity. We just see the opportunity to be focused. to do this really, really well and to do it right, because those that are focused, that do it well and do it right now are poised to do really good in this market as we see going forward. And some point in the future, we'll dollar cost average all over again and lower our average hold, raise our overall return. So, hey, everybody, thank you so much for joining me. It's an hour and a half, a little longer than I thought it was going to be, but I loved every minute of it. Can't wait to connect with everybody again. We'll talk to y'all soon. See you.